uh, start with a 2-minute introduction of yourself, as well as what the company does, what's your role at the company, how are you taking technology and technology and financial services to the next level at your company. Can we start with Monica then? 2-minute introduction of each of you, your company, your role, and how are you working on fintech at your institution?
Thanks, Anand. I'm a product manager, product management executive with Comviva. I'm a VP with their digital financial services unit, and we are interested in extending financial delight and, of course, financial solutions, right from the underserved to the most savviest of customers with digital banking products. This company is a leader in mobile banking solutions as well as mobile money solutions, which have served the underbanked for many, many years now. Now, in terms of my role and what I do, I'm a product strategist with a keen background of understanding the intersection and being at the cusp of consumer behavior, psychology, and of course, the ability to be able to provide financial products to them. I work in an enterprise financial services institution, so obviously I do understand how B2B2C products work. And previously, I've been with MasterCard India, leading their digital payments and partnerships verticals. And previous to that, I was at PayPal, which is one of the primary institutions associated with the wallet kind of behavior, and hence this intermediated a lot of banks as well as, of course, the networks. So I have experience across financial institutions and fintech for the last 15 years, when it used to be called just financial services. In fact, it didn't even have a drop down when we had to select what you used to do in job portals, and you had to select IT. That's the time that I got involved with fintech, and I find it very different now when people talk about financial tech and tech fin and everything being so cool. But I'm one of those uncool people joining very, very early in this particular enterprise.
Okay. Ankur, do you want to talk about your company and neo-banking for 2 minutes?
Yeah, so I think Arpit and Soumya gave a pretty good introduction. But yeah, just to add to it, I am heading the product at PingPay. It's a company which is working towards the upliftment and for providing better financial services to say tier 3, 4, 5 people. So we're building a platform, a neo-banking platform for our users in these areas, and we aim to make banking accessible to all in these segments. So I've also worked with another fintech startup before this assignment. I started my banking career with Axis Bank, and yeah, so I'm not a veteran like Monica, but yeah, I've worked in the fintech space since a while now. And yeah, I mean, it's a very exciting space. There's a lot of scope for a lot of products. Of course, we'll be discussing all of that in detail. But yeah, I mean, India has a lot of scope for fintech, and we are working towards, making banking accessible to all.
Sure. Sanjay, you want to talk about Acko and your role at Acko?
Sure. Hi guys, this is Sanjay here. I'm working with Acko. Acko is India's first digital insurance company, licensed by the IRDA itself. And how we differ from traditional insurers is basically that it is a direct-to-customer brand, and being direct-to-customer brand, the claims are also completely digital, digitally satisfied for our customers. So this was in itself an innovation that was brought into the field of traditional insurance by Acko as a company. And prior to this, I had my own company. I had a startup called Wheeler, which was acquired by Acko in late 2018. And what we dealt with was that we wanted to sell cars online. We wanted to sell new cars online, very much like an iPhone is sold on Flipkart now, which was not a very obvious thing 10 years back. And so that was the concept that we were working on. Prior to that, I also worked with a multinational called Rakuten in Japan. and I worked there for 2 years, uh, and learned a lot about the Japanese culture and their technological innovations, which I also implemented in my startup. So yeah, that's pretty much a brief about me and my career.
Okay. Okay. Tripti, is Pareen online?
As of now, he has not responded. I think he's facing
Oh,
some
okay.
issues. So
Oh, okay.
whenever he
Okay.
joins, we'll just immediately let you know.
Okay.
We can
Okay.
continue with the discussion.
Okay. I mean, shall we go to the discussion itself, panel discussion
Yeah,
itself?
yeah. You can move ahead with the panel discussion. And if
Okay.
somebody else can take up cryptocurrencies and other things, it should be nice. Otherwise,
Yeah.
I'll
Okay.
keep you
Okay.
updated.
Okay. Okay. Sure. Sure. Okay, Monica, we will start with you. See, with so much fragmentation in the fintech industry, of course, it's because of the innovation potential of the sector as such. But since there are so many players and APIs, it's a very complicated structure. So, I mean, what are the various security challenges for a company and from a consumer perspective? Because it deals with money, one of the most important commodities. So how do you ensure that when you open up your system to outside partners through API, or you work with 10 different, even for one single UPI transaction you pass through 5 banking channels, probably your PSP, then your own bank, then the receivers bank, NPCI. So you know uh, the strength of the whole network is dependent on just one player's strength. So, I mean, in such a scenario, how do you address the challenges arising from cybersecurity, or the lack of uh, investment potential of one of the partners in the whole ecosystem chain, and how complicated is it going to be, and how complicated it already is?
A great question to start off, but I must admit that I think I would like to demystify one particular thing. When we talk about cybersecurity, typically the financial institutions involved with providing financial services do an absolutely brilliant job of trying to make their system secure. Of course, we've had a lot of leaks in the past 1 month, which has brought this into a lot of disrepute and a lot of question. But if you ask me, if you ask any of the compliance folks at any of the banks, including frontline institutions, they'll tell you that it's such a cumbersome process that it actually pushes back innovation by a whole degree. Now, the question and then you'll ask is, why is it that we are facing so many cybersecurity risks? Because ultimately, we have to understand a very important part of this entire equation where frauds happen, which is consumers, which is businesses not understanding and therefore opening themselves up to being defrauded and then not being able to protect themselves. This is why when financial institutions start providing business protection, consumer protection, they become very, very bulky and it becomes very difficult to actually work with them because of the protection layers that are provided. But cybersecurity by itself, given the kind of given the kind of bodies that we have, given the kind of risks that are introduced and therefore systematically identified and managed by two different levers. One is the entire policy and the regulation lever that bases the regulation of the country trumps everything else that a company does. So you have to be compliant. And the second is, of course, a cybersecurity related guidelines that the company themselves have to adhere to depending on certain financial processes that they have to manage. For example, CISA, for example, PCI DSS. Now, what is surprising, however, is because all of these are actually snapshots in time, most companies will tend to put this on the back burner, deprioritizing it ahead of many others that need to be managed and many other features that need to be pushed out first. This is where I think we absolutely lack the discipline. And as product and everybody who's in product, everybody who's in business, we have to prioritize this first. Now, even in doing that, there are certain guidelines that need to be managed. And depending on how you open up and what your API process is, there are ways of being able to manage. You would have never heard of an API hack. You would have always heard of data being available. Now, this is where I think the strange part lies, because we invest a lot in trying to create the right things, but then we never really tie up the loose ends. So, a long answer, the focus really should be on making sure that our systems are secure. Once you finalize the guidelines under which the systems need to be managed, we have to make sure that these security guidelines are refreshed in a timely manner, and there is investment of both time, money, and resources in making sure that they are being invested in because it is a requirement. And third is consumer awareness, business awareness, and providing the right kind of incentives so consumers understand that when there is a cybersecurity related risk, it is up to their own, it is up their responsibility to make sure that they also play an equal party and make sure that this doesn't happen.
Okay, okay. Ankur, Sanjay, anything else with respect to this? Any of you would like to add? Because there is also there is only limited cash available with all these thousands of startups from which you can invest in all these cybersecurity measures or compliance measures and all that. So from that perspective, how much can you educate with that kind of money you have? So anything else that you would like to add here? Ankur, you want to go first?
Yeah, so I think Monica has made a very good point about opening the APIs, and of course, she has been in the industry, so it's more about I think being aware that you need to have certain checks in place more than protecting it from the outside world. It's more about having your systems in place so that you don't so that there is less of a cyber risk threat that is there. So yeah, I mean it's more about just ensuring that your system is ready for it.
Okay, okay. Sanjay?
Yeah, so I would like to put in my view from a startup perspective in particular. So what happens is basically as you start scaling, all of these problems start coming in. So when you are scaling, what you have to ensure that you have to keep building fortresses every time you are scaling on to the next level. And not only with respect to cybersecurity, with respect to compliance, with respect to valuations, with respect to funding coming into the company. Recently, we got to know that insurance industry in particular allowed FDI up to 74%, which was earlier only up to 49%. Like only 49% funding in a company, share in a company could be held by Indian investors, but that was opened. And so I would say all of these things start getting onto the better level as you scale up. And at each level, you have to keep building the hard fortresses. And since we all know that technology is in particularly a new subject, we are still not that mature as compared to the developed economies in particular. So we have to grow, but we have to be cautious at every step as well.
Okay, okay. What we have seen recently is there is a lot of discussion happening about digitization at the MSME level, at small merchant and trader level, the role of GST in enabling that. So, do you see small merchants and MSMEs are beginning to understand the value of technology, value of transparency that it brings to the whole business itself, and do you see all this enabling a kind of behavioral change? Ankur, you would want to go first
Yeah,
on this?
so I have worked in my previous assignment. I had worked with a lot of these small merchants, and we tried to sell them a product for their own small business. We are pretty probably too early that time, but now when we are seeing a lot of these companies that are selling things like a ledger for these small merchants, for example, or a payroll processing system for MSMEs and SMEs, and they're doing pretty well. So even if you just check their their Play Store numbers, they have more than 1 million downloads. They have more than three and a half 300,000 reviews. So they're getting good response from the merchants. However, merchants also have a lot of security concerns. So while we were, selling our product then, the one major concern was that, if I am keeping a track of my accounts in my book, that book is with me. But if it is on your server, I don't know when it is going to disappear. So That was one concern. The other concern was that I don't want my data to be shared with any company. These are my customers who come to me regularly. So I don't want to share their data with any third party. So say 4 years ago, 5 years ago, we were seeing these concerns. But today, like I said, just a normal Play Store analysis will tell you how well these startups are doing. So the this segment, the MSMEs and the SMEs are accepting new technology, and especially with GST coming in, there are a lot of times when they need to accept newer products and apps or platforms for maintaining their own accounts or for managing their own business. So what I would say is it's a little slow, but it is something that is happening, and it is something that is required for the future.
Okay. Anything else you would like to add?
Sorry.
No, I was just checking with Monica. Anything else she would like to add?
So, Anand, there is, I think Ankur has absolutely captured the essence of what is happening in the market. But the question is really, what are we looking for, and is a merchant looking for these digitization solutions? Because if it's a very nice vanity metric to go after 60 million merchants, and we are trying to digitize them, etc. But there have been some very large scale experiments by leading FMCG companies in places like Africa, including India, where there is a pilot that is actually ongoing, and even Reliance themselves are right now in the same market, doing something similar. But the question really is, the merchant isn't looking for somebody to hand them over a huge screen and tell them this is how you need to manage the inventory in your shop. Because trust me, the merchants, even while sleeping, they can probably manage the inventory a lot better than all of us in terms of very sophisticated digitized solutions. What they are looking for is to increase the footfall and to be able to manage the operational compliance because of GST and everything else. Also, I think we have forgotten that, again, it comes back to a very fundamental problem, which is GST has exposed this huge web of a lot of lies that are being also perpetrated in terms of tax and what will happen because merchants will come into the formal regime. What people are forgetting is that merchants are looking for only two things: larger footfalls and the increase of capital for them to be able to expand their business. If we are able to provide that, then GST and everything else that follows with it will only be a precursor to making their business a little bigger and making sure that they come into the formal economy. Right now, I think we are kind of, and I'm not sure that this is the right focus area, but again, I'm not really in the segment, but I do know that in the last 2 years, a lot of the large players, including the mainstream digital players like Paytm and Google, and everybody has been trying to go after them. But question is, what has happened of these efforts and why are they not succeeding? And the only reason I can think of is because the merchant will ask the question: you are giving me these devices, people will accept, like QR codes have suddenly become ubiquitous. Maybe that is the way to go in terms of accepting digital payments for them, getting more users to the store. But how can we solve the credit problem? So maybe the merchant problem is actually solving the capital risk problem and solving the credit problem more than solving the Kirana store issue.
Okay. See, the other issue that when we talk about reaching out to small businesses or small merchants or newer segments or sections is when we go to the bottom of the pyramid, when we look at low value, high large scale products, for instance UPI, while it has worked and was 50 paise or something like that. So, when you go to that scale, uh, are you going to make profits? Sanjay, if you can, explain it to us. I mean, how do you look at when you miniaturize your product and try and get large scale? What's the scope of making profits? I mean, there is no underwriting done for these products anywhere else in the world. Nobody has done this at this scale and at this low ticket transaction. So what's your visibility by selling insurance products, and when you tokenize at that small level, what is the business opportunity that you see?
Sure. Sure. So I would like to delve into the whole concept from the beginning. So what we call this is particularly micro insurance. And micro insurance could be of two types. One type could be a very small ticket size item for all the people that are already digitally aware, already in the insurance ecosystem, but you sell these products to get more and more data about them so that you could do better profiling of them. One is that. Two is, how do you sell micro insurance products to the customers who have never been addressed at all? So that is the second tier leg of the problem. Now, where we as a company specifically operate is in the first leg, wherein we have associations with a lot of companies who use our ticket size micro insurances, be it a cab ride, be it a stay in a hotel, even if you buy products from online websites, we have that data. If you take a small loan, so what we do is we curate all of these data together to build a profiling for customers, and that helps to actually understand what is the risk associated with a particular person, and that helps you to underwrite the person in that particular manner. For example, if I am a customer who does not uses his personal car often and is prone to using a cab, so obviously my car is not going out of my garage, so my insurance could be very cheaper than what a person who is taking it out every day should be. So these things, so these micro insurances are basically used by us to do profiling at individual levels. The other product, which I was saying, is that how do you bring the bottom of the pyramid into the financial inclusion? Why we do micro insurance for all of these people is because they have not been addressed at all till now. So how you can address them is basically having that hook. That's like a hook which you give them, and by that hook you pull them into the financial inclusion thing as overall. So there have been a lot of companies which have been giving insurances for particular diseases in itself. Say for example, there is a village or there is a town which is very prone to getting affected by malaria, for example. Now if you have a very small insurance product which only caters to that particular disease in that area, the people would be interested to buy that. And how you can reach out to them through technology is the best medium basically to reach out to these people when you want to do the financial inclusion. Now into micro
If I
insurance
can
for
interrupt there, I mean, wouldn't that mean that your claim rates would
yeah
also be high because you're targeting one? I know that's just a random example and not a real
yeah
thing, but
yeah
when you
yeah
do that kind of, uh, say personalization or a customization for one small
yeah
town or village, you know,
yeah
if everybody, even if everybody, from that particular town takes that insurance, the risk of claim rates going high is
which
you
is
know going
I would say Anand, which is fine when you want to include them, which is not fine when you want to keep them probably, right? When you want to have so when you want to get the lifetime value out of them, that is the time I would not really want to risk everything there. When you want to really financially include them, there are certain risks at that point in time because you do not even have enough data. Your first insight or your first idea should be how do you financially include them into the process of the financial product in itself. So that's the first idea that you have at that point in time. And like we were discussing about the UPI thing as well. So we had a similar question earlier. So when you are building new technology, when you are building new products, you will definitely have these hiccups come here and there. But that only pushes us to build better technology and better infrastructure in terms of cybersecurity, in terms of data, in terms of even using blockchain to some extent. If Pareen would have been here, he could have pitched in about cryptos and blockchain in detail. So how do you use technology uh, should be at the forefront of all the people that are trying to scale up businesses through this medium. And and basically two things are the most important as as people who are trying to give technology products to consumers, especially from an insurance perspective. One is profitability, one is distribution. So profitability automatically kicks in when you don't uh, have I mean when you have a lot of data about the people, when you can do risk profiling at individual people level, when you know their behaviors across different mediums. Distribution also gets better over here because you are using technology to reach out to people. You are not using any of the conventional broker related or agent distribution channels. So the distribution is direct to the customer, your relationship is direct to the customer, you have a much better understanding of the customer and you can profile it accordingly.
Anything else, Monica, you would like to add? The kind of scale versus profitability thing. I mean, UPI has, kind of reached the scale, but that's because government, banks, everybody has, in the ecosystem decided to forego their revenue model. So, I mean, where do you find that compromise when you reach out to the, bottom of the pyramid or, the scale that you are looking at in India?
So, I'm reminded of something which I heard in 2015, which is that the people who we think are bottom of the pyramid are actually capable and they are already currently spending a lot of money to actually pay back lenders. So this entire scheme of kitties and, the businesses that we hear about where people run away with all the money is all being funded by poor people. So if we only allowed them to actually maintain their savings, retain their savings, and to actually help them grow richer, which means basically lift them out of the poverty line first and then move them over, I think we do a much better job. So I actually don't believe that going and increasing the base of the pyramid actually helps or probably depletes your baseline or what we call the bottom line. I don't think so. I actually think because the number of transactions actually continues to increase, the ability to be able to offer a huge variety of services which ride on top of this digitized layer actually should increase. And this is exactly to the point that our friend was making here. Because when you think about packet and sachet size insurance, the minute you have trust in an insurance product which has worked for you, you'll be able to buy and you'll be able to sell many kind of insurance products to them. So I think this is a long term game. We tend to normally, again, that famous quote, we tend to overestimate what we can do in the short term and underestimate what we can do in the long term. Look at things in the long term game, because none of these companies are going to make money in the short term with 3 and 5 year horizons with these kind of customers.
Okay. So, Monica, that actually brings me to the other question. Actually, any of the startups can also answer this, but when you have that kind of a huge market opportunity, when do you stop investing, in expanding your market, expanding your, customer base, and stop, look and start looking at, say, profitability? So, I mean, the thing is, you can go on, expanding your market because it's after all a 1.4 billion market. So when do you decide to stop? Okay, now this is a size I'm comfortable with, and probably now I should start looking at profitability.
Maybe somebody from the startup world needs to go on that
Yeah,
one.
sure. Yeah.
So I can pull in here. So when you have these kind of questions in place, you obviously have the need to understand the fact that as a market leader, whenever you're raising money and going on to the next round, you have some estimations in place. So whenever you have an estimation, and ideally speaking, at least in my personal opinion, I feel when you are at a 2 to 5% of the market, maybe that's higher for some people as well, but if you are at 2 to 5% of the market, that's a point in time when you actually have to start looking in for the metrics breaking even. So I would say that's the point in time when you have to start looking at all the metrics being economically viable.
Ankur?
Yeah, so I think 5%, what Sanjay mentioned, is something that typically startups look at, 5 to 10% maybe. And I think it is eventually has to go in parallel. So there is a set of customers who are loyal to you, who are going to buy from you, and then there is a constant acquisition game also that is happening. So after you've got like a 5, 7 to 10% of the target market, that is when you start focusing on profits. But again, your customer acquisition does not stop, right? So you're not burning as much money, but yes, slowly that is something that is happening in the background.
Okay, okay. Pareen, uh, this is actually crypto is one of the top trending topics for almost 6 months now, maybe. So, I mean, what's the kind of interest that you see? I understand that you are in very 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 early stages of cryptocurrency as such. So there is no restrictions as to how much you want to grow as of now. But any thoughts on this? That
So, crypto is probably the newest asset class that we are discovering now. And of course, the market is very, very nascent. Although in last 10 years now, we've achieved over $2 trillion of market cap combined. But essentially, it is still a highly risky, high volatile asset class. So it's not even meant for everyone right now. What we say generally to investors is first learn about it and then invest, because we don't want a bunch of gamblers. We want people who understand the fundamentals. And one of the important questions that we ask is, for investing in a stock, you look at a company's balance sheet. So when you invest in Bitcoin or any other crypto, what are you looking at? If you cannot answer this question, you're not ready to invest. That's the first thing. What we usually tell people is, if you want to start learning, it's good to have some skill in the game. So maybe go ahead and invest 2,000 rupees. And then you start tracking the news, the charts, and then you get into fundamentals and learn about it. There's a steep learning curve to this. Also, what has happened with crypto is, now, because of Bitcoin's global adoption, it has become like a hedge against inflation, because there is a limited supply and it has proven to be secure for billions of dollars of transactions in the last 10 years. Now, Bitcoin has become a separate asset class, and every other crypto is a separate asset class. So, what we say is, usually when you go from FD to equity, your risk is raised by an order of magnitude. When you go from equity to Bitcoin, your risk goes up by an order of magnitude. And once you go from Bitcoin to any other cryptocurrency for that matter, a smaller coin, it again is as bad risk, as badly as risky as you going from FD to equity, right? So education is the fundamental part of what we are doing in the industry, and for the entire industry to inform people about how to go about doing this. Also, once people experience this hype, they are bound to go and buy various coins. Every day I get 30 calls from my friends and family, and they're like, should I buy Dogecoin? Should I buy this coin? I say, you don't even know what this does. So how can you even go ahead and buy this? Even if I tell you it's going to make some profit, it's going to be gambling profits. It's not going to be investing profits where you are an informed investor. So that's the stage where we are right now. It's like, when we talk to media, mostly they say, 20 years ago, people were afraid of investing in mutual funds and equities, and they just did not understand how this works. And it was good. They took some time to educate investors, to bring regulations, to make sure everything is safe and sound. And then it went to masses. Today, it is like, if I don't buy mutual fund or insurance, I am stupid not to do that, right? So it's assumed that everyone should start investing. But crypto will take probably next at least 5 to 10 years to reach that stage. Right now, everything is highly volatile also because it's new. Once the market matures, once the market cap goes about, let's say, 50 trillion or something like that, it won't be that volatile, and the volatility gradually decreases. The only theory right now that is very, very solid, what I tell, this is my personal opinion, but what I tell people is, only thing with any fundamentals is Bitcoin. Bitcoin has proven itself over last 10 years. It is highly, highly secure, and it has been used by largest of banks, largest of hedge funds today. So that's the only thing that has some fundamentals, and its claim is to be digital gold. We are yet to see. The lot of people get confused saying cryptocurrency. So is this currency or not? It's not currency. It's just an asset that you believe in and you hold because it is scarce, right? Why do I buy MF Hussain painting? Because it is scarce. Not that I'm going to look at that painting every day, all day, right? So it's an asset class. Understand that, and once you invest that way, it's easier to have a sane, sober trading strategy instead of just going and putting money on any coin that's just going up today. And that's what's happening in market. So
But
it's
I mean, because of the investor interest, uh, do you see less challenge in terms of convincing your potential customers or your customers in terms of regulation?
so
Because people don't care about regulation because ultimately, they want to be in.
true,
Do
true.
you have any regulatory challenges as such, or your challenges is more when government brings in
So,
a new regulation that changes the way people want to buy or sell or
right.
trade and things like that?
So it works both the ways. In our market, we usually have a 1 year bull run and 3 years bear market. In the bear market, people just hate crypto. People don't like talking about crypto. Every news that comes out is some investor who has said something bad, like Warren Buffett said something bad about Bitcoin or crypto. This is what happens. That is the time when regulation comes in and people are worried, and then they want to be risk averse because every day the market is just falling for 3 years. That's brutal. That's really brutal. And everything just keeps falling. Some of the tokens lose 97% of the value during these 3 years. That's madness. When there is a bull run, everyone wants to talk about crypto because the prices are
No,
going up.
I was
Everyone
actually coming from a government regulatory
so yeah,
perspective.
so from regulation perspective also, in the bull run, usually people don't care about regulation, and the regulation also subsides. So you must have seen in January there was a bill that was floated, which said they are going to ban cryptocurrencies. Then they used the word regulation. Then our finance minister went on TV and said we are going to take a calibrated approach. So they are mellowed down. Right now, from regulatory perspective, we are very positive because last 3 years, all we've been hearing is ban, jail, stuff like that. Now, the latest bill draft that's been circulating, it is a very, very positive step from our perspective. Although people these days are do not care about regulations because the upside is so much. Imagine my friend comes and tells me I invested in Ethereum and I made 15 lakh rupees just like that in 3 months. It's going to create such a FOMO in my mind that I don't ask this question about regulations, but it is pertinent. So, as an educator, I have to tell people that we are an unregulated industry. Usually, what happens is innovation comes first, and regulation takes time. So that is the stage where we are. When we say nascent, we are also nascent in terms of regulation. So we are working towards regulation. We are already a self-regulated industry. Most of the exchanges are a part of IAMI, and we have self-regulated, but it doesn't guarantee anything. Right? There are no audits, nothing. So when we go from here in the next 3-4 years towards positive regulation, that's going to be a massive change, and that's when everyone will join the industry. Today still there is a section of people who is apprehensive about regulations, but a lot of youngsters, possibly mostly our target we see is people from 20-year-old to 28 years old. These people haven't invested even in an FD, but they look at some crypto and they go and invest in it, so they don't care about regulations as of now.
Sanjay, I mean, when it comes to regulation, insurance is one of the most regulated sectors. So how do you bring product innovation? When you think about a product, do you think about, okay, what's the regulator going to think about, something like this? So I mean, how often does that inhibit your thinking, or reduces your free will to say innovate on new products or new services that you think of? How uh, how do you overcome that? I mean, what's the kind of discussions that you have with regulators before, during, and after these products are devised or thought about?
Uh, so to answer that question, although I am not personally involved in that, but from a company perspective, from where we come off as a company culture as well, is free will and thinking. That is why, if you see, we have been able to innovate over the years with multiple such products, uh, with hotel companies, with cab companies, with online e-commerce companies, lending companies as well. So I would say one thing within the company is always allowed, that you can speak and think totally innovatively, which is why I think Acko exists in the first place. So it's a completely digital insurance. It was never thought of in India before 3 years, I would say. And I think there is only one other insurer who is completely digital and certified by IRDA as well. So we were pioneers in the field of digital insurance, and we thought quite ahead of the curve. And personally, right now in the company also, whenever we are making products, I could say this from my team members coming in, they only think about the customers. What could be the best possible thing for the customers through a direct technology channel? Be it, which is why we were talking about Ola, that ₹1 insurance used to cover a flight risk and baggage risk of almost rupees 10,000. So, so the core of the thinking was always customers, and whatever innovation required, you do that, you take it ahead to the authorities and convince them somehow, which is why we fix a deadline accordingly. I feel what we do is we work always backwards. We fix a deadline when we want to launch the product, which is quite innovative in the market, and then we work backwards and account for the time that could take with the authorities in advance. Say it takes 3 months to convince them, we will put that into our calculation in advance, that those 3 months will go in probably convincing them to launch the product. So this, yeah, so this is the way basically that we operate.
Ankur, I mean, you are always at the mercy of banks because you yourself don't have a financial services special neo-banking license as such, even though RBI has recognized organizations like neobanks. So I mean, how much are you restricted by the banking principles or the banking channels? I mean, how do you overcome that when thinking of
So
product or innovations or even ahead, as in, because your growth is also restricted by how much banks give you access, how much banks give you leeway to use their infrastructure or network.
So I have a little slightly different opinion here, and it's my personal opinion. Regulations, I mean, they exist for a reason. So having that sort of a boundary where within which we are working is eventually good for the market, good for the companies, and good for the consumers. So uh, uh, I am. I mean, we've not really seen too much of friction because of regulations. Of course, there are instances where we've had when GST came in. For example, so there was a lot of teething issues then. But again, the regulations are being revised, and somewhere we so as a fintech, as a neo banking startup, uh, I mean, there's nothing that we cannot offer which a bank is not offering. Eventually every offering of the bank can be offered by us. So we've not really seen too much of a challenge when it comes to regulations. But again, if there is something which is a problem for the industry at large, uh, most of the times the regulators come to terms with it. So if there are 100 companies which are facing a problem, all the companies are going to make sure that they pester the regulator, and somehow they come to terms with it. Of course, there are still a few cases where that doesn't happen. But yeah, I mean, we keep trying to convince the regulators, like Sanjay said. We also keep trying to meet them and try and convince them to let certain things be. But especially for our business, there's not much regulatory issues that we face. And like I said, they exist for a reason. So um, operating within that boundary still leaves a lot of room for innovation. So it's I mean, it's good to have those regulations as long as they're not bothering everybody around.
Monica, anything on regulatory environment or regulatory challenges then that you face when working with a highly regulated sector like fintech?
I have a very conservative view on this because of my training and my experience back. So pardon that. I think the regulator is doing sometimes a fantabulous job of even consulting with mainstream fintechs and other technology players. But ultimately, at least in India, with the Reserve Bank being what it is, It's a very conservative approach, but a very risk-free approach given the size of the nation. I don't think we somehow still appreciate what they are doing compared to the years before, where just standing in their doors, trying to get an appointment and trying to meet with them was like a meeting with God, because it was like it was Judgment Day, and you don't know what would happen. Now I think they're a lot more open to consultation and advice, as also I would think of opening up themselves to innovation with regulatory sandboxes, etc., etc. But I'll say one thing, that as a financial industry, think about this not as somebody who is creating solutions, but somebody who is a recipient. You probably don't want your money to go to people to the wrong hands. Similarly, whatever you're building, there should be a certain ethical angle that one should always have in mind, because ultimately whatever you're creating is leading to people investing and providing their life savings and value, and you don't want to be probably losing consumer trust, because the problem is, when you use cash, and suppose cash gets robbed of you, you just blame God and circumstances and the economy and thieves and everything. But once a digital transaction goes wrong, that person will never come back to the transaction fold in digital, and that for us is a major loss. So I think as people in the industry, each one of us has this additional burden of responsibility to make sure that nobody has a bad experience, and if they do, then what can be a redemption that can be done as soon as possible within the remit of whatever we can control.
Okay, okay. You know, Monica, when you look at the kind of growth that we have seen, what are the kind of risks that come with this kind of a growth? From like what we see with the UPI, the transaction failures and all that. So how do you address that? How much do you invest ahead of the curve? How much do you see what's going to happen in the next 2 years or 5 years? How much do you invest in the back end as of today? I mean, how much do you plan that?
So, one thing that's very critical for all of us is, and as product people, we tend to probably spend a lot of time in trying to keep on rolling out new features. But in our backlog, we normally never get rid of the technical debt. I think we have a similar situation with products that become very big very quickly. But at the end of the day, the infrastructure really does suffer. And we've been hearing a lot. And, I'm taking the case of UPI, but that does not mean that I'm just taking this as an example. This does not mean anything else. But where mainstream banking institutions have actually failed, and the rap always is UPI is failing, but it's actually the bank's infrastructure which is not able to hold up. So whenever we do this very fast, when we are at the tip of this very fast innovation curve, we somehow forget that the technology layers that actually supported are the ones that need to be most robust, and our technology spending continues to actually go down, because we're too invested in doing very fast-paced product build-out and rollouts, that we forget that digital riding on a very weak infrastructure is actually going to lead to more problems later. So when I talk to a lot of the digital CXOs, the biggest problem right now is cost saving. But what they don't understand by cost saving is not reducing the number of people, but they're trying to figure out how can we reduce the cost of operations. But the fact of the matter is the cost of operations will continue to go up until we have a sustainable way of not having band-aid solutions to everything, right? So the infrastructure needs is something that it should be a cornerstone of how we develop products, how we think about our businesses, and more importantly, how we roll out solutions to customers. And customers should also start getting very acclimatized to frequent maintenance, frequent upgrades, but predictability in our approaches. When things go down, and there are 2 days of, for example, there was a time during demonetization where one of the banks went down, and people said that Visa and MasterCard is not working, these systems need to be replaced in India. People forgot that it was a banking infrastructure which completely went down. So, these are the kind of things that as digital customers, we should also get attuned to. And the fact of the matter is that whether we like to hear this or not, anytime that a CTO will tell a CDO or a COO that the budget for this year needs to be enhanced, they will be told and shut down. So maybe we need to have separate budgets for just infrastructure and security rollout, which probably will become our North Star metrics for a couple of years as we start stabilizing, instead of how many new users we got, what our retention rates are, etc. And you had asked this very pertinent question before, which is when do you stop building? When do you stop expanding? When you reach a certain stable layer where you start feeling that these are aspects which are critical to business as it exists today, because otherwise you will start losing customers. That's when you know that you need to stop expanding and concentrating on what is, and the new set of customers will anyways come once your platforms are robust enough.
Okay. Sanjay, I mean, how do you plan your cloud? People always talk about cloud being flexible. That's the one of the touted as the biggest advantage. You can expand whenever you want, but uh, still we hear glitches. So I mean, what's your plan? Say for instance there are going to be multi-million number of insurances. How do you serve? I mean, I know this is for you it's not a real-time thing like banking or crypto, but how do you look at the cloud or the tech infrastructure? Being a tech startup, it might be easier for you as compared to others, say for instance banks, but how do you address that? How do you look at that?
Um, like we had a discussion on this earlier. So the key of the technology to scale up is that how do you keep building fortress at every level? You have to go deep into a particular scale, build everything, log that out, and then probably move on to the next scale. And this you have to keep doing consistently. And as a technology particular startup, we invest heavily into technology. We have a huge tech team, which I would say is more than half of the company size. So not only in terms of number of people, but in terms of technology spends also, we do spend aggressively, and we have a lot of products in-house built, which although I would like almost even bigger banks would probably be using third-party sources for that. We have already started building such products within the company, because we know that as long as the technology and the product is in-house, we can always control and scale it according to our needs and know when to press the pedal versus when to stop. So I think deep down technology within the company, scaling it up as the need be, and addressing a new market only when you have totally logged this within that particular market and you have reached a scale which is not only I would say completely robust, but also completely serves the purpose of this particular market.
Pareen, I mean, you probably would have even less control over, how much Bitcoin is going to be traded next minute, next hour. So, I mean, how do you plan budget for that? That kind of, growth or transactions on your platform? How expandable or flexible is,
So
your
for
cloud?
us, we are a high beta market, which means anytime Bitcoin price or general market cap is going up, we see a load of transactions. And it's not just the entire market cap, but let's say one coin today goes 3 times or 5 times, like Dogecoin, then the entire system is under load. So from a tech perspective, absolutely every crypto exchange in the world, including the largest exchanges that do billions of dollars every day, they go down sometimes. So there are times when exchanges just can't plan for this, because the curve is not normally distributed, right? So for us, most of the year is just plain plateau in terms of traffic transactions, and one day or 1 hour it will just go like 500 times. So you just can't plan for this peak traffic. Although we have algorithms and we have things that we've figured out in terms of market cycles, because some of them are fairly predictable. But essentially, from a tech load planning perspective, our market is the worst possible. And in terms of being high beta market also, I think even stock market is a high beta market, and we've seen Zero the founder tweeting about how their entire DAUs, MAUs depend on how stock market is doing. But stock market is still fairly well distributed, so it won't happen that just one day in a year you will have every stock going up, which typically happens in the bull market, which we are seeing right now, and it has just started. So by end of this November or December, we expect this traffic to go at least 100 times from what it was today. Last year in March we did 25 million dollars of volume. This year in March we did 2.4 billion dollars of volume.
Okay.
So you can imagine how this is, and you will see similar hike in the market cap.
Did you see some spike today morning after SNL? Elon Musk SNL?
No. So SNL was supposed to be a dump call. It was not supposed to be a buy call. A lot of people bought Dogecoin thinking when Elon Musk says Doge on SNL, a lot more people will listen to it and end up buying it, which is actually wrong. So this is what is gambling, right? People just listen to Elon Musk and go ahead and buy a joke coin when everyone knows this is a joke. Why do you want to invest your hard-earned money in this? But it didn't happen. Today morning on Twitter, people were crying, people were abusing Elon Musk, people were abusing Dogecoin, and this happens. So next year, when you look at crypto markets, you will see everything is negative. So we have to prepare people for that. Not only our banking partners, but every partner that we work with, we have to prepare them that this year you are very aggressive. We understand, but next year you are only going to come and ask me 200 hard questions. Better ask it before the bull run, not when I have to go on defensive and justify stuff. So no one is asking hard questions these days. How decentralized is a coin and stuff like that. You just don't see that. But we can't control the entire market, right? So we try to educate as many people as possible, but that's about it. High beta markets, we've studied a lot of them, and none of them is as sharp in terms of drops and in terms of peaks also as crypto market, which
Okay.
is a good situation to be in and terrible situation to be in as well.
Ankur, I mean, in your case, you are, uh, dependent on banks, their infrastructure capability, their network. So how do you plan for your growth? How do you plan for your technology growth? Because ultimately, even if you expand everything, available to you, it all depends on how much the banks can, afford to do, or, banks can give you the chance to, run these many operations or these many transactions and all that. So, you know, how do you address that, API bottleneck between you and the bank?
So that's a very good question, something that actually touches my heart because we've always had a sort of struggle to work with banks seamlessly. So I won't call it a struggle. I mean, that's a pretty harsh word that way. But yeah, I mean, it is challenging because banks are not firstly as quick as a fintech company to develop something that is needed. So it is a little difficult for us to plan out our product launch or any kind of a rollout when it comes to working with a bank. So we always incorporate a buffer. There's always a 20-30% buffer that we incorporate when we are looking at say launching a product, for example. So if there's something which the bank says will take 2 months to build, we consider that it should be 2.5 to 3 months. So from a banking perspective, it's always good to have a sort of a buffer in place. And again, it depends on which bank you're working with. Certain banks are very good with their tech. Certain banks are not very good with their tech. So depending on that, it's totally subjective. But apart from banks, one thing I'd like to add is even regulations for that matter. It is a little difficult when to plan for the future when you have regulations coming in suddenly. So during demonetization, for example, there were a lot of problems that we faced. So one was, for example, when the merchant discount rate was reduced to 0 for transactions below 2000. That's when we saw a lot of increase in the transactions, which increased the server load. Secondly, when you look at merchants who were accepting POS payments, there again, all of a sudden, the day after demonetization, transactions started increasing. Banks were not ready to, their server were not equipped to handle, such massive load of transactions. So, more than 50% of the transactions were failing at these POS outlets. So, when it comes to regulations which have come, very suddenly or randomly, it's very difficult to plan in advance. But when it comes to banks, in my personal experience has been to, always have a sort of a buffer time in place, and a sort of a buffer, infrastructure in place for with us also. So that, things can happen smoothly.
Okay, okay. So, I mean, let's wind up this discussion. I think we have, used up the time allotted for this segment. So, shall we go for Q&A from students? I have a question from Alankrita now. So, is Alankrita online? Yeah, okay.
Yes. Good morning, sir. Good morning, ma'am. Thank you so much for such an insightful session. So my question is on RBI's central bank digital currency application. The deposits in which will be equivalent to the deposits made with the central bank, as RBI will have a complete hold over it. However, due to this, one of the most important aspects of cryptocurrency, which is that there is no centralized authority, will get violated. So what are your views on this matter? And do you think the people of our country will accept this cryptocurrency?
So this is one of the biggest myths out there. Okay, Bitcoin or any cryptocurrency is not here to replace USD or INR or anything like that. I can't imagine a scenario today where I go and pay for my chai in Bitcoin. Transaction costs are like $20. So, and it takes like maybe 1 hour at least for the transaction to go through. So that's not going to be possible anytime in the near future. Hopefully someday when tech challenges are solved, it's not even a medium of exchange as of now. So what RBI is doing today is called CBDC, Central Bank Digital Currency. What it means is it is digitizing at least the existing currency. There is no white paper on this out right now. There are no details publicly officially announced. As of now, it's just speculation. But essentially, it could be a cryptocurrency. It may not even be a cryptocurrency, right? It may just be a digital currency. What you see on your Paytm wallet today or a GPay wallet, that's digital money, right? It's just rupees in digital format. So that is what they mean. We will have to wait and see what the government releases in terms of CBDCs. But whether it is a cryptocurrency or a normal digital currency, it doesn't matter because there is a space for a central bank governed medium of exchange, and there is a space for assets also which are scarce like Bitcoin. Think of it as last 100 years there have been fiat currencies or government controlled currencies at least, and there has also been gold, right? We don't see these as competing with each other. They will both coexist, and there will be a utility for at least something like Bitcoin, which is savings. Like people do in gold, right? In India, we buy a lot of gold because we know it is a good way of savings. And people will also invest in fiat markets and trade in fiat markets and use it as medium of exchange. So what we need right now is not competition; it is interpolability of these things. And we've had people come from India Stack. And say how crypto will merge into UPI, not be a replacement of UPI. So this frame of reference which we are looking at is not right. Essentially, CBDCs will be converted into every other asset, whether it is gold or whether it is Bitcoin. So just look at it that way. Hope that answers your question.
Okay. Anybody else who would like to add to this?
I think, Anand, there has been a lot of experiments that are happening with a lot of the central banks, especially right now China, which is actually leading the race with a pilot already out. And actually the frontline players in the financial ecosystem there, which is Alipay and Tencent, seem to have revealed that they have already partnered with the People's Bank of China in order to roll out the digital renminbi. So I don't know what, again, I think I'm just going to agree with what Pareen just said, but I'll just say this, that whether it's Kazakhstan, whether it's India, whether it's even the USD, all these countries are trying to roll out an equivalent of their currency, which is right now regulated as a fiat currency and under the guidance of the central bank in their country. So we should not confuse it with a decentralized model that typically exists. in terms of the technology infrastructure, whether it's going to be on blockchain, which most likely it will be, and what the framework is going to be in order for the regulation to continue, as well as it to be authorized completely by the central bank based on their own principles of current cash circulation in the economy, is something that we'll get to know about in due time. But none of
So,
this
I
has
mean,
actually
the
come
thing is,
through
it's
right
going
now.
to be denominated to the local currency.
Absolutely. And I think people are forgetting that we are trying to mix and Pareen has said this absolutely beautifully. So I think we need to understand the slight difference between these two technologies, or at least the practices of how these were developed, and what does it actually mean for the end consumer, and what purpose does it actually serve, if at all.
Okay. Okay. But will it have a different value than, say, a single unit of, the government cryptocurrency will have a, different value than a single unit of rupee or a dollar? I mean, other than the fact that it's going to use the blockchain for trading or exchange, I mean, is there going to be a differential value for the government digital currency and
So
the rupee?
I don't think there is a need for a value to be assigned. See, today what happens is government just determine the monetary policy and supply. That's how they control the purchasing power, right, which determines the inflation and a lot of interest rates, right. To put it very simply, government doesn't need to or doesn't have to even determine the value, because they can just control the supply, and that controls the value in the economy, purchasing power of rupee. And having two different things, one is digital rupee and then cash rupee and exchange rate, that's just too much trouble right now. I think Japan has released one very comprehensive white paper on CBDCs, and probably they are going to be one of the pioneers as well, because they were pioneers in crypto regulation before anyone else, even US, figured it out. So hopefully we have to see these, because as I think what Monica said is absolutely right. These are experiments. Look at them as experiments. Uh, just to put it in context, if we are talking about internet, today is 1995. Okay,
Okay.
barely we are able to dial with a modem, and we are talking about building Facebook. Of course, it's going to happen. Okay, that's the promise of technology, that things will keep getting better, but it's not like it'll happen tomorrow, and it's not like there is a clear part to it. There will be too many experiments. Some things will fail, we'll take them out. Some things will work, we'll double on that. So as humanity, we've done these experiments for thousands of years with money, and this is just one more experiment that we are doing. So it's not a be all and all, and we don't have a clear path. That's the short answer.
I hope, Alankara, that answers all your.
Yes, sir.
Yeah.
Thank you so
Okay.
much. Thank you.
Okay. Sure. Thanks, Alankara. We'll move on to the next one. It's from Vindhya Reddy.
Yes, sir. Good morning, sir. It was indeed a very insightful session. My question is regarding neobanks, sir. So, since RBI has not allowed neobanks to enter the Indian market as an independent entity, how ready do you think are the Indian customers to accept such banking platforms?
Yeah, so this is not, it's not just an India specific question. Even if you look at countries where neobanks are a regulated entity, that's still a problem. So before that, just to understand what a neobank is, it's essentially a bank without any branches. So when you look at the Western countries like US, UK, Europe, Australia, there are proper regulations which allow neobanks to enter into the entire industry. In India, however, the RBI is silent on neobanking. So here, the neobanking startups that you see, they are fintechs which use banking services to offer them to customers. Now, the challenge here is going, even if the RBI allows, regulated entities to be neobanks, it is still going to be a challenge, because even if you look at the case of, say, Monzo, for example, which is a neobank in the UK, regulated entity, proper bank, there was a study which said that about more than 70% of account holders of Monzo use it as a secondary account. So their primary account is still with a traditional bank, and they are getting better services from a neobank. So here the whole challenge is about what kind of product you're building. Whether it is regulated, unregulated is still later, because even when we are offering our product, we still say that it is powered by ICICI Bank. So that still gives a lot of faith to the customer. But what is the problem that you're solving? That is mainly more important. So for us, the reason why we are targeting a particular segment from say tier 3 or tier 4 is because there are a lot of problems which traditional banks are not able to solve for them. But if you're building a platform that gives you an app which is equivalent to an ICICI iMobile app, that's not going to solve any problem for the customer, right? So irrespective of whether it is regulated or not, that is still secondary. It matters more as to what is the kind of value add that you as a neo-banking platform are giving to the user, whether it is a better interest rate, whether it is a seamless experience to manage your account or what. So that is more important in my mind. Does that answer your question?
Yes, sir. Yeah, it was clear enough. Thank you, sir.
Okay. Okay. Let's move on to the next one. It's from Kashish.
Hello, yes, sir. Am I audible in this way?
Yeah. Yes.
Yeah. First of all, thank you for such an amazing session. And now my question is on insurance. Like companies like Root Insurance, which analyzes the customer driving patterns to fix insurance premium, are facing regulatory hurdles in some United States of America on the grounds of data privacy. So, what are your views on that? And is India ready to accept such systems?
Okay. So talking about Root Insurance, particularly in the US, as far as my knowledge serves me, the very reason why they were facing some hurdles was because they thought of a new way of calculating insurance premiums. So typically what happens is you calculate an insurance premium of a car based on the car. And to some extent, now people have started saying that we will also analyze the driving patterns, etc. And some people have started saying that we'll put an OBD2 device, which is an onboarding diagnostic device in your vehicle, and they will analyze all of that to calculate how much premium you should pay. Root went one step ahead. Root said that I will do all of this from a mobile. The mobile phone that you use when it is in the car, when you're driving, so that mobile phone would be tracking all of this data to calculate your insurance premium. So this was one concern why it landed into that regulatory hurdle, and not specifically on the data breach, I would say. But yeah, to handle all of these things, like I said, you have to prepare in advance. All of these challenges will keep on coming for any new industry that thinks on innovation.
Sanjay, if I may modify the question a bit,
Sure.
how much is your customization or personalization going to be affected by government policies on data privacy?
Okay. So yeah, as far as we are operating right now, all of the data that is there, we have all of that data coming in from our products itself. We are not using any data that is of someone else, but we are using that data to actually underwrite our products. All of this data that we capture is being used by our customers. They are agreeing to share the data, and we are using that data only. Moreover, one very important thing with data that has been around in news is how do you use the data? All of the people who are using this data to underwrite products and things are saying that we are not taking any confidential details. What they say is we are just analyzing the behavior of that data. So if we see very recently, according to the GDPR guidelines, which is the General Data Protection Guidelines by the EU, so EU has started working on this, and to some extent this is getting solved, wherein companies would be able to not take the personal data, but would be actually able to understand the behavior of that data. So for example, to put that into perspective, I would be driving a car, so my data about driving a car would be shared, but details such as which car I own, how old it is, or what is the value of the car in the current scheme, all of these things would not be shared with the people who want to use the data.
that answer your question?
Yes, sir. It is very important. Thank you.
Okay. Okay. Let's move on to the next one. It's from Rishabh.
Yes, sir.
Yeah.
Am I audible?
Yes. Yes.
Yeah. Good morning, everyone. Thank you so much for this insightful session. So my question is related to the UPI thing. Recently, NPCI has imposed a cap on 30% of their market share. So how is this going to affect the volume for these market players to allow the customers to access digital payments, and as a whole, how it is affecting the digital ecosystem? Because it is imposing a cap and they are not allowing to increase the 30% market share.
Monica, I think it's for you.
It's a great question. Thankfully, there's a 2-year cap, so a lot of the digital players have a lot of time available. But I think one has to understand the reason, and of course, one can disagree with the reason. But the reason behind this is to systemically de-risk the concentration of the particular transaction majority with 1 or 2 customers, which is happening. So about 87%, I think, of the transactions are being directly processed by only 2 players, out of which, they keep exchanging leadership positions, which is fairly risky, because when you think about the size of the country and you think about the number of transactions, I think it was 2.64 billion last month. It's fairly large. But come to think about it, I think there are some customer related issues involved here. How do you actually tell a consumer you can't process, you can't use your this particular app and you need to move to something else? But I think this is probably a little bit of a afterthought, keeping in mind that there were so many institutions which were actually provided and granted the regulatory institution and licenses in order to actually proceed ahead and create solutions, but none of them actually took off. And I think this afterthought and oversight has probably been overlooked, which needs to be corrected right now. But think about this from a slightly different point of view. Even with the 30% cap, there would be the ability to be able to serve many millions of customers, which would probably make it the largest consumer and target base for any such player anywhere else in the world. I personally see that this is probably going to see its round through. But however, there is going to be some sort of changes that one should expect to this regulation in terms of how it will be imposed. Maybe there will be a way to be able to throttle the transactions at the back end without any customer impact, and be able to process the transactions differently with the mainstream frontline remaining the same. However, this is just a product thinking on my side. I don't know how it is going to work at the back end, but great question. Quite honestly, I think we are going to be faced with a lot of these challenges in the future because the systemic concentration risks that a lot of the systems are providing need to be systematically managed. And NUV, which is a new umbrella entity, is also a step in that direction.
Okay. Anything else, Rishabh?
No, ma'am. Thank you. No, sir. No, thank you so much, ma'am, for this answer.
Sure. I think that brings close to our discussion. So